Ryan, if you'd like to bring anybody up, go ahead and do that.
All right. I suppose I won't let the full song play, but just want to give a couple people a few minutes to come in, and we've got some good potential speakers here. So I don't know if anyone wants to raise their hand if they want to chip into the conversation. I'm more than happy to have a few of the folks in here, particularly the ones that I follow. Please don't be offended if I don't pull you up, but there's some folks that I think have a pretty unique inside perspective that we want to be able to take advantage of. So if you would like to raise your hand, then please let me know. I can bring you up. And Doug, just to confirm, you all can hear me just fine, right?
Crystal.
Awesome. Okay. So I wanted to do this basically because I just didn't want to write anything. And there's a ton of stuff that's kind of going on behind the scenes. And the way that these events typically play out is there's a bunch of investors that have zero incentive to talk about what's actually going on behind the scenes for confidentiality reasons, for, they don't want to spread FUD, for relationship reasons. And frankly, I'm probably in that same boat too, but we're in a pretty unique position. I'm in a pretty unique position since I've been around for a little while. On the one hand, and I've been in the middle of stories like this in the past, and then maybe most importantly, I have I think probably a much better than average understanding of how some of these really exotic products work that Three Arrows Capital had gotten blown up on just by virtue of having kind of worked at DCG and being very familiar with the Grayscale products, having written about them in my annual report at the end of the year, and not exactly highlighting some of the risks here, but talking about the bad trades that went sideways with the Grayscale trust assets for Three Arrows Capital and BlockFi in particular last year, right? So a lot of what we're seeing is, in some respects, it's a redux of that with staked ETH, and Luna was slightly different, but three kind of structured distress trades that went seemingly against Three Arrows Capital right back to back. What I wanted to do tonight is not like peddling rumors and fear mongering, but just talk about a few of the kind of questions that I've had that I've been trying to get answered behind the scenes, and share what I'd say is like kind of aggregate feedback on kind of what we know right now, what the outstanding questions are. Disclaimers here. There's still a ton of speculation on this, and I'm hoping that this recording can prompt some corrections, quite frankly, right? So this is almost like the live equivalent of Cunningham's Law. I want to be kind of careful and not say anything that's FUD inducing or outright incorrect. But I do think there's some things that I'm going to be pretty clear on right from the onset. These are best guesses, and these are a lot of whispers, and these are a lot of things that have been directionally confirmed by some folks that are in the know behind the scenes, but they're not necessarily facts. So please don't treat them as facts. I'm not I'm not kind of staking my a journalistic reputation or anything like that behind some of what I share. So with that said, a few things to kind of go over. So I assume that most people that are on this call are familiar with Three Arrows Capital. Huge, not fun, but kind of family office and principal capital allocator that estimates were between 10 and $20 billion, probably closer to the high end of that in terms of assets under management. The one figure that I've heard that we'll kind of come back to in terms of like the total net liabilities here. Basically, they're wiped out. And the whisper number is between like 1 and 1.5 billion is the net liability number. Now, I don't really have much more detail beyond that. Wouldn't be surprised if it's more than that, or if it's about that. If it's kind of on the money, that's good news. One reason that it could be more is if that 1.5 or 1 to 1.5 was an estimate, including Three Arrows like mark to market assets, right? So like all the other venture portfolio stuff that they had, that's ultimately going to be used as collateral and probably like unwound at discounts to other interested buyers that might just scoop up those whole baskets or kind of wholesale positions on the cheap. So potentially that hole could be greater if you assume that that 1 to 1.5 was based on some of the illiquid stuff that they have that's probably going to be sold at a discount and then unwound and ultimately put them maybe even north of that figure. So it's still quite a bit of money, but importantly, I don't think that 1.5 billion is something that will cause really horrible stress on the lenders in the market. So the last few days. I've been asking around, and you've seen this on Twitter. You've seen this from other sources, but I can also say that we've personally, either me personally or as a company, we've had a couple of transactions with BlockFi, with the Circle guys and Genesis, and they're pretty robust right now in terms of their liquidity. That's at like $20,000 Bitcoin. That's, with all this like crazy unwinding that happened like from Sunday to Wednesday, but we didn't have any problems. It was kind of business as usual. And as always, those teams have been really professional and responsive. So, I believe, kind of what they're saying in terms of maybe the worst being behind us in terms of some of the exposure that the big lending desks have, to this particular counterparty. Now, of course, none of these guys are going to come right out and say it's Three Arrows, but I think for those of you that missed it, both BlockFi, Zach from BlockFi and Mike Morrow from Genesis had threads that were very, very similar in tone and substance the last 24 hours, basically saying we don't talk about customer accounts, but there was a large liquidation of one of our customers, and over the course of doing business, from time to time, we exercise our discretion and use risk management practices to take certain decisive actions, and this was one of those cases, and we're not going to comment further, but this is the way things are. And between the lines, the educated guess is that that's about Three Arrows, right? So the U.S. lenders, kind of Western lenders that had some exposure, I think are relatively, unless they just outright have not been totally forthcoming, which I doubt. I think that risk has probably been taken care of, and potentially there were losses, but nothing that couldn't be absorbed by their working capital and the broader kind of balance sheets that they have. I know at least one of those counterparties, and directionally what their working capital is, they're fine. The one thing that could have been really tricky is understanding what was the remaining GBTC exposure with the Grayscale Trust. So, I don't want to do a whole dissertation on exactly how these trusts are structured, but suffice to say, and again, I wrote about this in the year-end report, the Grayscale Trusts are quasi-ETFs that are really weird in the sense that you can create shares that represent the value of the Bitcoin that goes into the trusts, but then you can't redeem them. You can only sell them in the public markets through this thing called Rule 144, the details of which are not important, but basically it means it's a Hotel California trust, assets go in, they don't come out. The only path to liquidity is to sell in the public markets. The problem is there's been a 30% discount to the shares versus the underlying for the last couple of months. And there was an open question as to whether Three Arrows still owns 6% of the trust, because that was the last public filing that they had beginning of last year, and that was right before the GBTC premium, which had kind of traded at premium for years, flipped to a discount, and that was one of the trades that both BlockFi and Three Arrows took a loss on. The reason that was interesting is if that position was still live, it could have done two things. One, it could have caused a lot of stress for GBTC, the stock in the public market, because there was no telling whether people are going to be unwinding that. It looks like Bloomberg took that position down to zero. There haven't been public filings that suggest that Three Arrows Capital actually sold those shares. So what I've been hearing basically is, Bloomberg might have taken that number down to zero because that's directionally more accurate than the 38,888 million. So much for that being lucky for them. That's more accurate to just kind of put it down to zero, because that position is being actively unwound as we speak. And I think that the bogey is maybe there's still about 20% of that disclosed position that's held by Three Arrows are still in the process of getting unwound, which would be, maybe about $100 million worth of GBTC shares, not 6% of the $10 billion trust. So, that's good for, public grayscale investors. It's good for a little bit more certainty in the market in terms of how much of that position has been unwound. It does seem like Three Arrows was able to kind of sell a big block of that, either, over the course of the last 18 months, they sold some of it down, or, they had some OTC trades. Frank Chaparro had a good scoop over the block on the Three Arrows guys basically trying to do a block sale and a structured transaction around their GBTC position as recently as like 24, 48 hours ago. So we know that at least some of this position has still been kind of active and in play and something they've been trying to leverage. But it's not like 6% of the trust is going to have to be, market sold tomorrow in the public markets or on Monday rather. So I think that's one good thing that was de-risked. So you basically have Western lenders with good working capital positions, but still, maybe the diciness for those businesses is it really comes down to just, are we going to have continued pressure on like the Bitcoin and like Ethereum price just because of macro conditions, but not necessarily like more forced selling from this particular counterparty. So that's all good news. Then we've got kind of the last thing, I don't know how much more like counterparty risk or contagion is baked into this, but the one kind of thing that has been whispered about and really don't have a good sense for which projects could be in this bucket, because this has probably been the most hush-hush thing that I've heard so far, is how many project treasuries and which projects actually had financial relationships or kind of principal relationships with 3AC. That's one of the questions that I'd love to see answered in the next couple of weeks, and that's probably the scariest potential answer for specific projects that may have had significant chunks of their treasury under management at 3AC, and maybe those communities just those funds don't exist anymore, right? That's the kind of really negative kind of downside scenario, but that's just conjecture at this point. And I would imagine that most projects are going to be pretty buttoned up about that, because if I'm a betting man, some of this will go to litigation. It'll have to be worked out over time. So recap the numbers, maybe about 100 million of GBTC, maybe about 1.5 billion up to that in kind of net liabilities in terms of how underwater 3AC is, and relatively good kind of working capital at most of the other lenders, and some proof that it's been business as usual for basically any counterparty that I've talked to that's been transacting with these guys over the course of the week. So all the FUD about the sky is falling for all the Western lenders, I think is probably overbaked right now, or overdone. But that's not to say that there couldn't be stress if the market just organically dumps again because we fall through support. This is my kind of partial brain dump, but I do better in Q&A sessions anyway. And also want to make sure that if there's anyone else that wants to join the conversation or has interesting things to say or call me out on for just being totally wrong, then they have the opportunity to do so, and we can go on with other questions. And before I get into questions, for those that may have joined in the last little bit, I am trying to figure this out just like you, but I'm the only one stupid enough to do a spaces about it because no one else wants to talk about this stuff publicly, and that's something that hopefully will change in the next 24 or 48 hours. Doug, do we have any hands raised or anything like that?
Yeah, we've got 4 folks that have requested. I don't know if any of them are familiar, but we can start bringing them up one by one.
Do you want to just Slack me the names so I don't get ambushed?
Yep.
Given the sensitivity here. And I'm going to go with real names as a bias, Doug. So
yep, we've got one real name here, and it's Mr. Eric Turner.
Eric, fire away. What's up, Eric? You're speaking, but you're on mute.
Yeah. I see a lot of smart people here, so I think the big question is, what does everybody think about the asset liability mismatch for 3 Arrows? Are they liquid or are they not?
No, I think that they're absolutely insolvent. I think that's the 1.5 billion in net liabilities essentially being like net. What are they underwater? Right. I think that's the over under is 1.5. And I see Kobe just joined, so I'm very excited for him to raise his hand and just make the whole. In terms of like how that 1.5, if that is the number, first of all, I don't think that anyone knows what the number is because there's been so many firms that have liquidated their positions, and we know that they had a massive book and well over 10 billion in AUM, but how that broke down between private and liquid positions, and then these kind of structured products like the GBTC product that they were borrowing against, it's not at all clear. I think the one thing that I didn't mention, we know that they did have a couple of nested funds or kind of quasi funds. Not exactly sure about the financial relationship, but Defiance Capital may be in significant trouble, and based on some of the tweets that we saw from the founders over at Defiance, unfortunately, certainly seems like the rumors might be true that basically all the gains that they had earned from DeFi in 2020, 2021 were basically appropriated and lost as part of the overextension of Core 3 Arrows.
We've got a Wayne Vaughn requesting Ryan, if that's familiar.
Yes.
Hey Ryan.
Great to see that. Great to see Zach here too. I'd love to have him have the opportunity to comment if he so chooses. But obviously, Zach, you just showed up at a point when I had wrapped up. One of my punchlines, though, was I've got confidence that the Western lenders in particular, you guys included, have been kind of managing this pretty thoughtfully. And even if there were losses, no issues about working capital or, at least no concerns on my end based on what I've heard and what we experienced firsthand. So after Wayne asks his question, would love to invite you up if you're interested. And I know there's probably a limited amount that you can say, but certainly welcome. So, Doug, why don't you tee him up while Wayne asks his question first?
Hey Ryan, I'll give you a nice softball before Zach. So obviously this whole situation with Luna and Three Arrows, everything that's happened the past few weeks, is a great excuse for regulators to introduce new rules, regulations, and controls over the crypto industry. What kind of things can we do from a self-regulatory standpoint that can help prevent things like this from happening in the future?
I see Kristen Smith here from the Blockchain Association, so maybe we can invite her up for the second part of this answer as well. In my eyes, we've been working on self-regulatory products basically, and trying to build an Edgar for the industry, basically since late 2017 during the last bit of euphoria, and we've been working on that pretty much nonstop ever since. I do think, though, that disclosures from projects themselves are not the answer, and this kind of proves the point. Like the real self-regulation we need, or the regulation that I think we need to expect and, if not ask for, is transparency on the part of the lending firms, the custodians, and then the large, the material investors and beneficial owners of some of these tokens, because they're the ones that are ultimately going to be dumped, right? Either in a distressed manner. Or just, in a programmatic manner because they have a fiduciary obligation to sell some when their investment goes up 100x, right? That's a totally reasonable path for a venture capital firm that invests early in a project, has outsized gains, has LPs on the other side that they need to satisfy, and need to take chips off the table for. But it's the lack of understanding in the market for how those tokens actually flow. And then importantly, as we start to see more token-based governance, we can argue about whether that's a good or bad idea another day. But if we do start to see more token-based governance, you got to know who the voters are and who has the voting power, right, in these networks. So my argument has been, don't regulate the peer-to-peer protocols themselves, but regulate any centralized player that has, that is domiciled in, or does business in, certain countries, in Europe and the U.S. Maybe we could have some cooperation on regulation there. If you have a minimum ownership threshold, you're responsible for disclosures similar to what we see with, 13G, 13F filings and Form 4s in the public markets. And in fact, that's how we knew about, BlockFi and Three Arrows positions in GBTC last year, because of those public filings. So I think if we saw more of that, you'd at least be able to track when people were getting overextended, and then you could use the blockchain, to do a bit of the rest. I would love to see more work on that. I think, it's something that we've already had in the back of our minds, MSR, and we've been iterating on. And quite frankly, I don't think it's gonna be a choice. So people are gonna have to come together and figure out what are we fucking doing here? Because if the answer is nothing, then we're gonna get our clock cleaned. But if this can be a catalyst and actually get a little bit of urgency on the part of some of the kind of major deep-pocketed players in the industry to come up with some solutions about at least market efficiency and market transparency. I think we'll be able to maybe kick save some of this. The cynic in me also kind of believes, though, that the rest of the world is falling apart. So this might be small potatoes compared to what Congress and kind of policymakers are going to have to deal with in macro. Kristen, are we going to be a scapegoat, or how bad has sentiment changed from when we were all dressed up and fancy at the Coin Center dinner to the after party?
What a difference a week makes.
Was that the top? Was that the pico top for our regulatory positioning? That felt like it.
Yeah, no, listen, I certainly hope not. And my thoughts are forming on this, and I figure if I'm still trying to figure out what the heck is going on, then I think most policymakers are a little bit behind where I'm at, just because I think about this more hours a day than they do. But I think, going to Wayne's question, I don't think there's much we can do from a self-regulatory or best practices standpoint that's going to be very satisfactory. I mean, I think the best case scenario is that some of these isolated incidences, Lunaterra, Celsius, turn into talking points for getting legislative action next Congress, and that we stay on that timeline, right? Because we have a bunch of good bills out there. We've got Lemus Gillibrand, which is pretty decent, needs some work, but pretty good. We have the Digital Commodity Exchange Act, pretty good. There's legislation coming together in the Senate Agriculture Committee that's going to put together like a spot regulatory framework that I believe would have disclosures as a component to that. So there's a lot of good moving pieces. It's happening in both chambers of Congress. It's happening with both parties involved. Like everything is in a nice spot. And so, if we can keep that work going, I think that, as you were saying, Ryan, these events are provide a little bit of sense of urgency that they need to act quickly. What we don't want to happen is for things to get much, much worse for, consumers and retail investors to, lose all of their investments that they thought they had or something like that, right? And that's when Congress starts to act really quickly. So I think hopefully we'll be in a good spot where this will lead to a good regulatory outcome via new legislation, right? I think the regulators have done most everything they can from a regulatory standpoint today within the authority they have. Now, what this does do, I think, is this puts a whole lot of enforcement attention on some of the sort of problem areas. And, there's two ways to look at that. Like, one, that's bad, right? Because it's going to mean a bunch of bad headlines. But two, like, we kind of got to weed out some of this bad stuff. And so I would rather have the enforcement focus on the actual, more reckless actors and not, the good guys that are just trying to do the thing.
Well, yeah, I mean, that's and I wrote about this and kind of spoke about this earlier this week. But if the SEC wasn't intentionally stonewalling a spot ETF, we wouldn't have $6 billion of investment funds underwater, and we wouldn't have a couple of the kind of big losses on the structured products that the big lending desks had, Three Arrows included. Zach, you were at least partially on the wrong side of that trade, but kind of I think liquidated that and kind of managed risk around that last year, and obviously made money on the front end of it when GBTC was still at a premium. But the big question right now, I'll kind of leave open-ended to you. I don't know what to ask you, but maybe the starting point is like, what can you tell us? And like, what are you able to communicate? I appreciate you coming on. I think everyone else does as well.
Yeah. Hey, everybody. Happy to be here. This is actually the first time I've ever hopped on a Twitter Spaces. I was doing my nighttime Twitter reading and logged in. I totally didn't realize that when I logged in, you would see me and ask me to speak. But all of that being said, I think a couple things. So look, just in the last couple minutes since I've been listening, I could not agree more with a lot of the stuff that Kristen said. I think that I would want to say that I also see that this is being recorded. But look, I would want to say that for anybody affected negatively by Three Arrows or Celsius or Babel, I feel bad for them. Obviously, these are not good things for this space. I absolutely love this space and believe wholeheartedly in the potential of it. BlockFi, Ryan, I noticed because someone on our team mentioned it, had a very busy week. We have processed every withdrawal that's come onto our platform, and we're going to continue to do that. And I'm excited. The team is excited and doing a phenomenal job burning the candle on both ends right now because everything is very busy for obvious reasons to get us, help be a part of getting to the other side of this cycle. And the space is going to be stronger. The good companies are going to be stronger. The regulation's going to get figured out. And, cryptocurrency, market cap, TAM, whatever you want to call it, is going to get much, much bigger in the future.
Zach, I think you guys did a great job communicating directly. I think both. I think you had the first thread, and then Mike Moore at Genesis had something similar. They were both, I think, really well communicated, and that's obviously confidence inspiring up to a point. But people are just freaked right now in general, going risk off, particularly with like the structured crypto lending markets, just given all of the unknowns and some of the known unknowns, but the unknown unknowns I think are the things that people are really losing sleep over. Aside from just communications, like how are you guys firming up working capital and trying to build like a really robust balance sheet against this to make sure not that you, nothing is ever guaranteed, right? If the markets continue to spiral out of control, but how do you just kind of shore up the confidence element of it? If the markets go down, that's one thing. Then everybody's working capital goes down on the lending side. But like, how do you basically prove resilience, I guess, for lack of a better term? Is this something where you're able to be more public with your reserve requirements and kind of working capital position just to quell those fears? Or what do you think can be done right now? And then, do you think that there's a solution for this from a self-regulatory standpoint going forward? My thesis is that this is not going to be an option soon. So is there something, you guys and Genesis and some of the other Western lenders could do to get ahead of this?
Yeah, great question. I'm going to take this one, Ryan, and then I'll hop off, read a little bit, and get some sleep. But my guess right now would be that a self-regulatory path is not a particularly viable option. And in terms of the instilling confidence question, look, there's one part of that for a business like BlockFi's that's really simple. You process every withdrawal just like you always do. There's another part of that is your question about, how do you instill confidence from a capital perspective? And then there's communication, and we're focused on all fronts.
Fair enough. Well, Zach, I appreciate it. I know you guys had a long week, and you got to be careful with exactly what you're saying, especially late on a Friday after you're sleep deprived. I think it is helpful having you in here and just hearing straight from the horse's mouth someone that's kind of in the trenches. Is there anything else before we let you go that people should be keeping an eye on in terms of kind of just maybe not with other lenders or kind of speculating on who might be having stress from a liquidity standpoint, but are there other price levels in particular where you think that we'd have maybe more liquidity stress if we have like another leg down? Is 10%? Is it 20%? Like when do you think that there's potentially more risk baked into the system?
Look. Short answer, no.
Okay.
No, not in the way BlockFi manages risk, at least. But
all right. Well, thanks for the color, and we'll let you get some sleep.
Yeah. Thanks.
Frank, you've been doing good work here, and you graced us with your presence. I don't know if you wanted to speak and compare notes, anything that I may have missed or overlooked, but I think you had the story today on Three Arrows trying to sell that GBTC position, which is how we know that they still had it up through 48 hours ago. And maybe before you got on, I talked about the number of shares that has yet to be sold, probably around 100 million. But I don't think that's coming straight from 3AC. That's coming from another third party that they must have done a block transaction with OTC that's managing that unwind. Any other color there, or things that you're hearing?
Can you hear me all right?
Yep.
So basically, what's interesting is they've been hitting up everyone, trading desks, token projects, the story that you're referring to specifically was on a structured product that would allow them or help counterparties profit from a GBTC arbitrage. So this deck that they sent out started circulating only a few days before the blow up. So a lot of folks that I talked to speculated that they kind of knew that the merry-go-round was coming to an end. So they, potentially figured they could win it all back in one trade. The other thing that they were hitting up token projects about in the days before the liquidation across all those venues was effectively pitching several different token projects on having them take on their entire treasury to do treasury management for these projects. So they've and the entire treasury. So there's projects that I've talked to that were being pitched on having them send Three Arrows, hundreds of millions of dollars of their treasuries tokens, which is pretty. It's pretty phenomenal given what happened over the course of this past week. And then they also were pitching them on lending them Bitcoin and ETH. So, rates have been increasing given the Celsius meltdown in terms of the rates that lenders are charging more to lend out cash. And that's a whole different topic, which trading desks are talking to me about. But the one thing that Three Arrows was doing in the days before their blow up was saying that we will, if you give us Bitcoin, we'll give you 3%. If you give us ETH, we'll give you 3%, et cetera. So it was clear that they were, made a valiant effort over since, let's say, June 5 to get as much capital into their firm as possible and their affiliated firms. And this is part of the problem with crypto right now is no one understands the scope and breadth of any of the companies that operate in this market. Three Arrows, Celsius, any firm. And there's a reason why in traditional finance you have distinctions and separations and firewalls between these functionalities because it mitigates risk. You don't have an exchange that owns a broker, that owns a retail broker, that owns an OTC desk, that owns a prime broker. It just doesn't exist. In crypto, all these firms do the same thing. And so Three Arrows had this affiliated OTC business where they, did structured products. They did trading, and through that vehicle, they were trying to effectively shore up their overall balance sheet. And it's amazing to think about the further damage that could have been done if they were successful in wooing those potential counterparties.
Yeah. Frank, have you heard anything? And I see Rob Leshner join. Maybe he just dropped off again. So we'll see if he comes back. But if he does come back, Doug, you can see if he wants to come up and maybe talk about the DeFi lending protocols and some of the stress that might be there. Frank, have you heard anything more specific about treasuries, different token treasury projects that we're working with 3AC?
I haven't. As you can imagine, only the ones that did not, send their tokens willingly to Three Arrows are the ones that have talked to me, because clearly there'd be quite a headline risk to any firm that might have done that. But yeah, it's interesting because it's the terms of some of these deals are also really bad. So it's been funny to hear the stories of these people that have been approached by Three Arrows, because they're scratching their heads at this point and thinking, you would have thought if these guys really wanted to shore things up, they would have at least given favorable terms. And of course, there's further speculation that this was somewhat nefarious, like they just kind of wanted to kick the can down the road to an extent. Now that is up to people to decide. I'm not going to pontificate on on the intentions, but this is the reality of the situation, what has been happening. And now we have to focus on where we go next, right? I think counterparty risk management is a topic that a lot of people that have been coming on my show and that I've been talking to across Telegram and Signal have been saying is everybody, Joe Weisenthal tweeted earlier, these guys were supposed to be the smartest guys in the room. So, you turn a blind eye to certain things. How could everyone, not a single, risk manager or, trading desk have thought maybe we're lending too much to these guys or putting on too much risk or not examining the parameters of the loans we're giving out to these folks enough. And now I think that's certainly going to happen. And you've already had institutional lenders across the market pull back on loans dating back to 2019 that I've heard of. So it's happening, and that's going to drive liquidity, and that's going to result in more volatility, and at least the near to medium term.
Yeah. Smartest guys in the room. That always ends well. If you get three structured trades of that size wrong in a row, I don't think you're necessarily one of the smartest guys in the room. But they got Luna colossally wrong. They got GBTC and that trade colossally wrong. I mean,
but so did everybody. When the music's playing, you got to dance.
Underwater. They were underwater on 6% of GBTC. They were borrowing against the shares that they created to lever up long more to basically yield farm GBTC when that premium was still a thing, and then it turned on them. They shit the bed on that one, and then they had Luna for $500 million, and then they had the wash on staked ETH. So 0 for 3 on some colossal.
Fair enough. No, I meant Luna specifically.
Look, man,
I get what you're saying.
Look, man, I don't care. It's pretty mid if you can get into the $10 billion range and then have zero after that. So you're not going to get me to back off of that one. But Frank, I appreciate you. You're doing great work as always.
Yeah, thank you. No worries.
I love you guys. But
this is crazy. 4,000 people, Ryan.
Twitter verified.
I feel
a bunch of verified folks.
Come on! You don't have a verification? I can help you.
No,
I got your back.
Listen, I tweet bad words, but Frank,
I'll tell you, I got to give. I find it funny that Zach, poor guy, just came into the thing not knowing that he'd be seen. This is actually a functionality I've talked to Twitter about implementing, which is for blue checks and large accounts that you can enter these things with incognito. Poor guy. Just completely taken off guard.
Where's the fun in that? Where's the fun?
Yeah. All right. Thanks, Ryan.
I think it was great, and it is great to hear from you. It was great to hear from Zach. We have one more speaker at least. Frank, thanks for joining.
Cheers. Thank you.
Rob Leschner from Compound is here. Rob, I'm not going to ask you to speculate on the centralized lending protocols, but what do you think the state of health of the DeFi protocols are? Just given all the market stress and some of the liquidity issues, some of these pools are getting out of balance and curve. Can you just kind of give us a breakdown for some of the washout risks that exists in the things that we can see on chain, but people might not necessarily be paying attention to or as familiar with how to spot the risks?
Yeah, well, first off, thanks for having me. This is a great conversation. The most important thing to understand is that everything that's happening in DeFi is radically transparent. And you can ask me questions, but then you can go, you can second guess them and you can gather the data yourself. And, this is incredibly important because it's a different type of market structure than a lot of folks are used to. And 3AC blowing up is a function of them operating in a market structure that's existed for most hedge funds in most businesses on Wall Street for decades now that didn't benefit from the transparency and the autonomy of DeFi applications and markets running on chain. So, in terms of the state of DeFi right now, in terms of lending protocols, so you have a couple major lending protocols that 3AC and Celsius, are active users of and borrowing heavily from, mostly, MakerDAO, Compound, and Aave. All three of these are transparently incredibly healthy right now. So, all three of these have experienced liquidations due to market price changes over the last couple days and have held up incredibly well. Unlike the last or the first, major stress tests when the markets were in calamity, in 2020, for instance, there's no doubt that these protocols are strong as hell, have suffered no losses, so to speak. And, you can actively monitor them in real time. I mean, a lot of people on Twitter are posting the addresses of, folks like 3AC and Celsius monitoring their account health. And so I would say right now, the lending protocols are incredibly robust. And in a lot of ways, this is a victory of DeFi 1.0. In terms of on-chain, pools of assets, STF, other things that you can observe in curve pools, prices are a little bit out of whack. There's not as much liquidity for, stake Ether as there used to be, but it's still robust enough that 3AC was able to exit their position, that, any normal user can exit their position. You can, have enough liquidity for pretty much anyone in the world that's not, let's say, Celsius. And so I think in terms of just like the depth of liquidity for most of these assets, it's still incredibly strong. I think over time, what I hope the conversation shifts to is that DeFi can prevent the root cause of the failure of Celsius and the failure of 3AC. And the root cause of the failure of both is opacity. And it is having no ability to judge the health of those actors or their books or balance sheets at all. I got excited about crypto and excited about DeFi because I began my career on Wall Street in 2007, right as everything began blowing up. And everything began blowing up because it was a crisis of confidence and liquidity. No one knew the state of anyone else's balance sheet. Nobody knew what anyone else was holding, and everyone stopped trading with each other because there was fears and there was rumors. And it's the exact same thing to a T with both Celsius and 3AC. Nobody has the information. We have Twitter Spaces right now, and the title of it is Fact or FUD because it's hard to separate fact and FUD. And this is because all of those actors have their own ledger. They know what they're holding. No one else does. An open ledger that's shared by every market participant, like DeFi running on Compound, is the exact opposite. You're not holding your own cards. Everybody's using the same shared system. There's accountability and there's transparency. And when we move to DeFi over time, it's going to prevent the next Celsius and it's going to prevent the next 3AC. But the reason they blew up is because while they were using crypto assets, their business models were still extremely archaic. And we're going to continue to see Celsius and 3AC blowups in perpetuity for businesses that are run the same way. And, I think this is hopefully an incredible turning point for, the crypto community to begin to finally appreciate the power of the technology that we're all working in and actually use crypto to change business models, not just do the same exact error-prone, opaque, fear-prone business model that, a closed book, platform like Celsius or a closed book hedge fund like 3AC has been using. So I'm actually really excited about the long-term benefits of this for the space. And, I hope that everyone can learn from this event and grow from it.
I think that's good and aspirational. But Rob, I think, realistically speaking, before you hopped on, I was talking to Kristen about regulating the edges, particularly the custodians, or anyone that's kind of managing the tokens on behalf of customers. If it's an exchange or a hosted wallet or, a lender, some type of proof of reserves on kind of the one hand, and then also like understanding like the major beneficial owners, right? So even if you can mix wallets, if you're a large centralized holder of cryptocurrencies and you're based in the US or you're based in Europe, you physically live there, if there were some just basic disclosures requirements around holdings and how they're changing over time, like you have with 13Fs or kind of Form 4s in the public markets, that seems like it would be a pretty logical. Do you think that's something that, I mean, you've dealt with this and just trying to run a DeFi project, but also make sure that it's not being used like in Iran and you're trying to basically think about how the community, the protocol itself could self-regulate a bit, so still be open, but not get any of the early market participants in trouble. What's the balance here, right? Because I think I agree with you that the protocols themselves shouldn't be regulated. We should try to do that at the edges. But what would help? Because even with Compound, you're going to have central parties that can have a major impact on the day-to-day health of the network and the health of that on-chain order book, even if it is on-chain.
Yeah, I don't have all of the answers for you. I think having disclosure requirements is great for some market participants, but it's not going to cover market participants in foreign countries. It's not going to necessarily change really anything, in my opinion. Like, you still could have 3AC, which is a Singapore-based hedge fund, doing exactly what they were doing. I don't know if the disclosure requirement is going to prevent the next 3AC, right? I think I
think you chip away at it, though, right? I think more often than not, an entity gets to the size of like 3AC, and they're going to be on someone's radar to register. I'd imagine, I don't know, maybe this is a pipe dream, but one way out of this would be if you had kind of the U.S. and maybe some of the European regulators who are relatively aligned on some of this. Just say, all right, if you're in our country and you're operating a fund of this size, or you're in our country and you're a regulated money transmitter or custodian, here are the requirements for reporting token holding, so that we have at least some standards around market transparency, right? Because you're not necessarily going to get that in peer-to-peer networks, but you can get it at the edges. And even if that's 60% of the market, that's better than zero.
Yeah, I mean, it's obviously incrementally beneficial, but again, I don't think that would change, what occurred with 3AC. Everybody knew that they were a massive firm with a lot of surface area, right? And, having those types of, additional, steps taken at the edges still would not have given anybody a clear picture of what 3AC's risks were, what their books were, and they still would have been able to borrow from everybody with a pulse, which is what they did. And the reason why things went awry is because nobody was able to get the full picture of 3AC's book. Nobody knew how bad it was. Nobody, was able to, check that they weren't pledging the same, private market collateral to 7 different firms to borrow with it. Nobody had any insight into the health of 3AC. Yes, they were large. Everyone knew that ahead of time. Knowing that they have a lot of positions, at 3 custodians, I'm just making this up, let's just say at Anchorage and Coinbase Custody and, Fireblocks, I don't think would have changed anything, really, because everybody knows they had a huge book, but nobody knew the solvency of it or the liquidity of it, and that's the root cause here. So if you want to see, not just small incremental improvements, first, I think we have to accept that there can be a better and a different market structure than we're used to. And I think that's a huge opportunity for regulators and legislators. Instead of trying to, operate it in an old market structure, like, adding disclosure requirements, looking at the new technology like DeFi and saying, hey, this can be a radically different and radically better, not just incremental improvement, but a step function improvement to market structure. And I think when we start having that conversation, good things will happen. And, this will not be the last time that, there's a disaster in our space, but, it can be, hopefully one of the last times where, it's because they're doing things the same way that every hedge fund and bank on Wall Street has been operating.
Rob, appreciate you hopping in here. I know you're probably just in to listen, but then I sniped you from the audience. So thanks for the quick feedback. and I really did want to get that perspective in because, we've got a lot of kind of centralized players that have been, the talk of the last week. But we had, obviously Luna just a month ago. And then we've got some kind of stress with staked ETH and some of the curve pools and potentially now Babel, as you mentioned. So it's kind of systemic just based on the market action. This is a really good, yin to the three arrows yang. Hopefully things stabilize from here and we don't have too many people that get liquidated and, lose a shit ton of money. Thanks for the perspective.
I agree. Thanks for having me.
All right. So we're getting to the top of the hour here. I will hang out for a little bit and have time to answer a few more questions if anyone else wants to pop in with a question. Can you please tweet it either at me or Masari, at TubeIdiot or at Masari Crypto, and Doug can help curate anything that he's seen that's come through. Just given the sensitive nature of kind of what we've seen the last couple of weeks, I don't want to take questions from people that I don't already know, which is why I've just been inviting people kind of as they come in. And if I've invited someone and they haven't taken the stage, then that's their prerogative because it's late at night and they might be doing other stuff. So appreciate everybody that tuned in tonight, and I'll give Doug a couple minutes here to dig through if there are any questions. But while he is pulling that up, I will say, for those that haven't read it, I did cover a lot of this in the annual report that we published at Masari. It's free. So if you just look up the 2022 theses on Masari, we cover a few of these. The grayscale issues, the lending markets, kind of DeFi lending, some of the potential issues that we could see with leverage. So I certainly don't think that I predicted anything as even remotely close to this in terms of unwinding. But there is some good stuff there if you're looking to learn about some of the structural issues we're talking about tonight. And then lastly, I'd be remiss. I'm working hard. Our team's working hard. Dougie's working hard. It's 11 p.m. on a Friday, so if you're not already subscribed, $30 a month, Masari Pro. Get your ass on the site, masari.io/pro, or better yet, buy a mainnet ticket and get Pro, and we'll see you in September in New York for one bundled rate. Dougie, any questions come through, or am I off the hook?
You're off the hook. Negative.
Okay. Well, appreciate everyone coming in here. We'll keep it to a nice tight hour because I know we start to lose people at the top of the hour. I am going to sign off for the weekend. So thanks very much, and stay safe out there. Wear a helmet. We're all going to die someday, just not tomorrow.
GN, everybody. GN.